Okay, so we've looked over or we've discussed the closing process and the entries needed, and now we will take a look at an example. So we're going to go through S4-10, which is on page 210 of your textbook. So open up your textbook and we'll go through this one. Okay. So S4-10 says that Curry Ice Road Trucking provided you with the following list of accounts. And it gives you a variety of accounts there and their balances. It says, please prepare Curry Ice Road Trucking's closing entries for the above accounts and include explanations. If it doesn't tell you, then you assume that these are normal balances. So the typical balance you would see in each of these accounts. Right, so the closing entries, remember there's 4. We close our revenues to the income summary, then close our expenses to the income summary. Third, we close the income summary to the capital account. And number 4, close our withdrawals to the capital account. So we'll look at closing entry number 1. Doesn't tell us a year end, so we don't have a date. And this is, you don't need to write this every time, but since this is the first one we're looking at, I'll just put close revenues to the income summary. You basically look through the list and find all of the revenue accounts that exist, and then we do the opposite of what their normal balance is. And that their normal balance is a credit, so we'll debit all of the revenue accounts. So if we look through the list, cash, no, Curry, no, revenues. So that is the first one we will debit. So we'll debit revenues, and you're just doing the opposite of the balance. So we do the full balance. So we'll debit $28,596. AP, no. AR, no. Amortization, no. Equipment, no. Interest expense, no. Long-term liabilities, no. So this revenues account, that's our only revenue. So we just have one to close. So we credit the income summary account. For the same amount. If there was more revenues, you would just do one entry and your credit to income summary would be the total. And an explanation to close revenue accounts. Okay, closing entry number 2 is always to close the expenses. So find all the expense accounts and close those to the income summary. Okay, so if we look through the list in the textbook, the first expense account that we see is amortization expense for equipment. So what is the normal balance for an expense? Right, it's a debit. So we need to do the opposite. So we're going to credit amortization expense for equipment. And that was for $2,090. Go back to the list. The next expense account that we see is interest expense. So again, we'll credit that. And it had a balance of $726. So we'll credit it for that amount to get it to 0. And those are the only expense accounts. So we've only got 2. We've closed them both. Our offsetting debit is to income summary. We know debits always need to equal our credits. So if we add 2,090 plus 726, we get 2,001 or 2,816. So that's the amount that we debit to income summary. To close expense accounts, Okay, closing entry number 3 is now to, whoops, sorry. Oh, I don't want to do that. Oops, sorry, you guys. Wow, this darn pen. Okay, here we go. So we're going to close the income summary account. So the account we've just created, we close that to the capital account. So what I always like to do when I get to step 3 is just quickly do a T account so I know what's left in the income summary. So if I do this up here, this is my income summary. So in closing entry number 1, we credited this count, $28,596, and in entry 2, we debited it, $2,816. So we now can calculate the balance after those 2 entries. So we take 28,596, subtract 2,816, and we get to 25,780. So income summary is temporary. We need to get it down to 0. So we're going to debit the income summary account here. And we debit it for that 25,780 that we just calculated. And we're crediting the capital account. So there is a typo in the textbook, or not a typo, but the second account there just says O Curry. Well, that's O Curry Capital. They just didn't put the capital there. So we would say O Curry, comma, capital, and we're crediting this amount. Now, back on the earlier slides in the first video, I talked about when we're left with a credit balance in income summary. So that's what we've got here. Once we posted closing entry 1 and 2, we have a credit balance in income summary that needs to be closed. And that represents the net income of this company. So the revenues that we closed totaled $28,596. When we closed those, we needed to credit income summary. We closed our expenses, and the total of those were $28,616. So because our revenue is more than our expenses, we're left with this credit balance in income summary. And we know that when you have more revenues than expenses, it's equal to your net income. So this balance that we're now closing to the capital account, that is our net income balance. So we close that down here. If we had more debits here, so we had a higher amount of expenses than we did revenue, we would have been left with a debit balance. And that would recognize or represent a net loss. So if your expenses, your debit amount was larger than your credit, you have a net loss. Okay, so that's closing entry 1 to 3. Closing entry, or I need my explanation to close income summary. And closing entry number 4 is always to close withdrawals to the capital account. So if we look at the textbook, there is no withdrawals account. So O Curry didn't take any money out of the company, and therefore there's no entry needed. So if there's no withdrawals balance, you don't have that entry. So closing entry number 4, we just don't have one this time. Okay, so that's a look at the closing entries. One example, you basically just pick out all of your revenues, do the opposite sign. Pick out all your expenses, do the opposite. And then you close this income summary account, which you created from entries 1 and 2, and then close the withdrawals if you have any. that's one. Now I want you to take a look at E4-7. So practice this one on your own. It goes through, again, preparing the company's closing entries. So it wants you to post these entries. And then part 2, in the textbook, it just tells you to post whatever you posted in entries in number 1, post them into the T accounts. But I want you to actually use these accounts. So on the next slide, I've provided you with T accounts, and I put the opening balances from the question in there. So in part 1, I want you to do the entries here, and then post these entries into these T accounts that I've provided and calculate the ending balances. And I just want to note that for cash, I've used an opening balance of $2,900. The textbook says $1,000, but you'll see later why I've used this $2,900. So go ahead, practice this on your own, and then once you've got through it, come back, and the next video I will go through the solution.